Good morning, and welcome to the Finley Davis webinar on pension plan terminations, aligning the stars in the complex decision-making process. For those who would like to take notes on the slides, a link was included in the confirmation email you received yesterday. A few of you have submitted questions in advance, which we will address either when we're covering that topic during the webinar or at the end of the session if there's time. If you have questions during the webinar, please type them in the chat area on the right side of your screen. If we are unable to address them all in our 1.5 hour time slot, we'll stay on the line to address them for those that are interested. We have two presenters today. Presenting first will be Blaine Brooks, who's a fellow of the Society of Actuaries and an enrolled actuary. He's managing consultant in Finley Davies actuarial practice and has extensive experience consulting on retirement benefit programs and providing actuarial services relating to the design, installation, and plan administration of qualified and non-qualified retirement plans. Blaine's worked on about 300 plan terminations of varying sizes since the late 1970s. The second presenter is me, Colleen Miller. I'm a senior consultant in Finley Davies actuarial services practice, and I've served in a project management capacity for a wide range of pension and retiree health care benefit matters, including valuation preparation, strategic planning, plan design, accounting calculations, funding, forecasting, administration, and compliance. So a quick visual piece to quickly outline Finley Davies' areas of expertise and what our focus is today. There's an employer-employee value proposition for all employee-provided compensation and benefits, and Finley Davies consults on all of these employee values, including compensation and incentives, health and group benefits, wellness, retirement benefits, and communication strategies for all of these. Under retirement benefits, we can work with defined contribution plans like 401k plans or 403b plans, executive retirement benefits, and our high-level focus today is on defined benefit plans or pension plans. We sometimes tend to slip back and forth between DB and pension in our terminology, but what we mean is the same thing. We're talking about plans with a promise of annuities at retirement. Within the DB pension plan topic, there are many strategies that Finley Davies covers, including asset and liability management, de-risking, administration outsourcing, plan redesign and hybrid plan design, funding and accounting planning, mergers and acquisitions due diligence, in-service distributions, and the focus of today's webinar, which is plan termination, and the interrelated steps involved in the complicated process. Finley Davies has created a one-page visual piece to lay out the steps in this process, and we call it our path to defined benefit plan termination. Now this is kind of small to read on this slide, but you received a link to this in your confirmation email yesterday, and you can also find this on our website, and you'll see that at the bottom left of this slide here at www.finleydavies.com. Blaine's going to be covering the preparation topics listed at the top and all the planning needed before moving ahead with plan termination. And I'll be covering the steps along the path once plan termination has begun. So with that, I'll turn it over to Blaine to get us started.
Right. Again, my name is Blaine Brooks, and I'm a pension actuary with Finley Davies. And I wanted to address planning issues for plan terminations, both what I call advanced planning and also final planning. Advanced planning could be only a few months before the termination starts or as many as 5 or more years before the termination. Final planning really addresses the final details of the termination process as it begins and would take place a month or two before the actual termination starts. There are several types of pension terminations: standard terminations, distress terminations, and PBGC initiated terminations. Today we're going to discuss standard terminations for single employer plans, which is a voluntary termination. Distress terminations are for organizations that are in bankruptcy or near bankruptcy, and PBGC involuntary terminations occur when the PBGC forces a plan termination, usually for a plan sponsor which is in final financial distress. A lot of pension plans have frozen benefits, either as a hard freeze or a soft freeze. I'm defining a soft freeze in a situation where the plan's been amended so no new employees enter the plan, but a portion of the plan's participants continue to accrue future benefits. So for practically, that's just an ongoing plan. A hard freeze occurs when all benefits have stopped, and usually a hard freeze, under that, there's an ultimate goal to eventually terminate the plan. Unfortunately, a lot of situations now are they can't be terminated without a lot of cost. However, there are a few exceptions for terminating a plan, even with a hard freeze. A plan sponsor may know that it's going to be acquiring other companies and wants to merge the acquired plans into their own plan, or especially if the plans are overfunded, some underfunded, overfunded, there's advantages to blending those together to avoid excise taxes. The sponsor may want to have a frozen plan but still have an early retirement window incentive program, or the sponsor may want to just temporarily freeze benefits but then restart benefits at a later date. But most of the time, once the plan is fully frozen, the goal is to eventually terminate the plan. So advanced planning is appropriate even if the plan termination is several years away. From an advanced planning standpoint, issues to consider include financial considerations, investment considerations, time frame, data considerations, and communication considerations. Okay, next slide. Financial considerations, of course, the first question would be how much additional cash is needed to terminate the plan. And to do that, you want to evaluate the unfunded liability on a shutdown basis, either as an annuity cost basis or a lump sum basis, not on a funded ratio basis or accounting basis. The funding ratio is now calculated under MAP 21, which was special legislation enacted last year, definitely understates the shutdown liability. So those ratios are much more favorable than what the true shutdown liabilities would be. And the accounting liabilities may also understate the shutdown liability, so it's important to know what type of liability you're looking at. Contributions to fund the entire shutdown liability are generally fully deductible, except in some rare cases for small plans, plans with less than 100 participants, where the benefit formulas have been increased the last couple of years, may have deduction limits for the highly compensated employees. Then the strategy really is over what period of time do you fund the shortfall? Is it over 1 year, or is it over 5 to 7 years? And another question is contributing more than the minimum required contribution desirable? So that's another issue to look at. For some companies, the question might be, is borrowing to fund the plan feasible or desirable? With the current low interest rates, one theory would be to borrow enough to fund the plan and then pay off predictable benefit payments to amortize the loan as a possibility. Financial statement impact is really the most, I think, surprising or could be surprising element. At the time the benefits are distributed, all unamortized actuarial losses from an accounting standpoint become a one-time special charge to earnings. And this charge is not an extraordinary item, although it is a non-recurring item. Losses can be primarily due to very low interest rate environment and also net investment experience over the last several years. Although we've had a good year this year, if you're looking back the last 10 or 12 years, investments still are behind what assumptions would have been a number of years ago. In the current environment, the settlement cost, which is a charge to current earnings, it can be very, very large. It can be as much as in the range of 50% to 75% of the value of the assets. So it can be a very, very large number that affects earnings. And actually, ironically, making additional contributions does not reduce this loss if it's recognized now in the current low interest rate environment. Now, other considerations are really investment considerations. Finley Davies is not an investment advisor, but the plan sponsor would want to consult with both the actuary and the investment advisor about what risk to take during the overall process. For a plan that was an ongoing plan, it's not unusual that the funding policy would have had investments of a range between 65% equity and 35% bonds, or more conservative plans might have been a 50% equity, 50% bonds. But once you've frozen your plan, then you're in a shorter time frame, and if you're looking at even a 5 to 7 years horizon, you may want to consider looking at your investment policy to see whether it's appropriate to lower equities and increase bond percentages. Another part of the policy might be to, as the plan improves in its funded ratios, is to move some of the percentage in equities to bonds as that ratio increases. Now, once the termination itself starts, the time frame lowers to about 12 to 18 months typically, and so therefore continuing to invest in equities becomes more of a gamble. From a very long time frame, equities generally outperform bonds, and that's why there have been higher percentages in equities. But now you're looking at, once you terminate, you've got a very short time frame, and so the question is whether it's appropriate to stay in equities. Now, what's not at all intuitive, though, is that investing in cash or money market instruments when you terminate the plan is also a gamble, because even though your assets are going to be protected or safe, the liabilities are still subject to changes in interest rates. So a 1% decrease in long-term bond yields could increase your liabilities 9 to 16%, depending on the duration of your liabilities. So investing in cash, it actually is a gamble if interest rates move down during the process. So really hedging the plan where you minimize the change in the unfunded liability would be moving more toward long-term bonds of a similar duration to minimize the fluctuation in the unfunded liability. That's not at all intuitive, but that's you can have a small decrease in interest rates and really have some bad news in the process. Another thing from an investment standpoint is to see if there's any non-liquid assets that exist in the plan, such as hedge funds, real estate funds that could be limited on paying out, or other intangibles. And also a goal really is to not overfund the plan, because if you overfund the plan inadvertently, there's a 50% excise tax for profits and 20% excise tax for not-for-profits if any of those monies come back to the plan sponsor. The 50% can be lowered to 20% in some cases, but the idea really is to keep the plan a little bit underfunded until you know right at the time of payout what you need to pay, so that you're not involved in any excise taxes. The time frame generally will be 12 to 18 months. File with the IRS. If you don't file with the IRS, the time frame might be shorter, 6 to 12 months, and these are just averages. That could be more or less. But also in the time frame is really the time to clean up data and get everything prepared so that the termination process can go as smoothly as possible. It is a difficult, timely process. Doing cleanup ahead of time is important. For data considerations, again, data issues can be a real problem with completing the termination on time. One question is, are the accrued benefits accurate and final? For some plans that have frozen their benefits, they're still working off valuation accuracy data and may not have a final accrued benefits. It's really important during the interim period before you actually terminate to get the accrued benefits calculated exactly so that you can proceed with the termination as smoothly as possible. Another question is whether the underlying participant data used to determine the benefits is available, particularly for vested terminations. This would be salary history and benefit service for all participants. Again, getting that ready for when the termination starts. Our address is up to date for all participants. You can use locator services to obtain addresses for missing participants and alternate payees. Now, Now, PBGC does allow in the termination process for last-minute missing participants, but it's critical to go through a bona fide missing participant locator service to go through and do everything you can to find those participants. And then also, of course, review any qualified domestic relation orders to get all those calculated exactly as they need to be. There's also communication considerations. The formal notice of the plan termination must be within 60 to 90 days of the proposed termination date. Now, that's not the distribution date, but just the date that the termination is considered to have started. Also, if the plan is not fully frozen, the notice of benefit freeze must also be provided at least 45 days before the freeze date. And usually the two of those can be given at the same time if needed. We recommend that in the termination process, when you're communicating the termination, that any new or enhanced replacement program, such as a 401k enhancement or 403b enhancement, is given at the same time that formal notice is given. And it's really good to do as much detail as you can on that, not just say, well, we're going to improve the 401k, but go ahead and be as specific as you can on what improvements are occurring. And there's also any other issues which need to be considered, such as union issues, community issues, or public relation issues, or other corporate issues that need to be addressed at the same time. Of course, union plans will need to get the union's agreement in order to terminate. So once then you've got a target that you're looking at, either a funded ratio or a plan termination underfunding, to know when you're going to start the termination process. Now, next slide. For the advanced planning, really the goal is to look at having the plan funded somewhere in the 90 to 95% funded ratio, knowing you'll need to make some final contribution but not overfund the plan. And you also are aware of whatever financial issues, settlement costs that need to be evaluated, what the implications of those are. Now, the plan will need to be amended to terminate the plan. Also, if there have been any regulatory changes that require plan amendments, those will also need to be made. Those are best to be made early in the process before the communication of the termination occurs. One other issue that needs to be evaluated is whether lump sum options will be provided. Now, if a plan has always paid lump sums, during the termination process, they can continue to pay lump sums like they always have. But if you had a situation where, let's say, lump sums up to $20,000 were available, and you extend that to unlimited lump sums, you could only pay the $20,000 lump sums during the process, and then at the very tail end, at the final distribution, you could pay the unlimited lump sums. Often, adding a lump sum for non-retirees can lower the cost compared to a group annuity, but that's not always the case. And if you're in a situation where you're having rising interest rates, that needs to be evaluated whether that's appropriate or a good idea or not. Now, for current retirees, it's less favorable to pay lump sums than it is for non-retirees. So that, again, that needs to be looked at, but it may be a situation where you would add lump sums for non-retirees, but just buy an annuity for all the retirees. And again, you just need to go through some modeling to see what the advantages are there. If you allow lump sums for some of the retirees, about half of them will take it, half won't, and then the insurance companies will probably charge more for any selection on those that pick the annuity. So there's a number of considerations there. For very, very small plans that have just a few retirees, you probably would want to allow lump sums in the event to let them pay out lump sums, but again, depends on the circumstances. Now, another consideration immediately prior to the termination is whether to file with the IRS for the determination on the plan. We recommend that you do file for a determination letter, but it does take longer for the plan termination, typically 12 to 18 months for the whole process, compared to maybe a 6 to 12 month time frame if you don't file with PBGC. What the IRS is going to look at is whether all the plan amendments that have been required have been adopted. And the second issue that they're going to look at that is really an unknown is who needs to get vested when the plan terminates. Usually, participants who have not had a break in service are required by the IRS to become vested, but it really depends on how the plan wording is and really with the IRS agent that you're dealing with as far as who gets vested. There is potentially a 5-year look back if there have been significant reduction in actives over the last 5 years that could trigger additional vesting of a different group of participants. And that just depends on facts and circumstances. Okay, next line. Now, annuities, early in this process, you'd want to engage an annuity consultant to work with you about what's involved on the annuity side of the ultimate settlement. You'd want to make sure that the insurance company selected meets what's called the safest annuity provider, which is required by the Department of Labor Interpretive Bulletin 95-1, and it's not. They lay out 6 criteria that need to be considered in selecting the what's called the safest annuity provider. So your annuity consultant would do that part of the work. And there's been talk about that when interest rates go up, there could be a capacity problem with insurance companies where they can only take on so many annuities at one time. So that's another potential factor down the road that we might need to deal with. For after the fact, once the plan is paid out, there's about a 100% chance that the PBGC will audit the plan if the plan has more than 100 participants, and about a 33% chance if they have under 100 participants. So one of the critical things during the whole process is document all the communications with participants and plan documents. Keep those for at least 6 years, and really prepare almost as if it's a given that you will be audited, so that the audit after the fact can go as smoothly as possible. It's very hard if PBGC comes in a couple years later and goes through an audit to try to reconstruct what happened if you don't have good documentation of the process. And then the regular filings continue to need to be made during the process. Form 5500 and the PBGC premium continue and are due at the regular times. The last 5500 is due 7 months after the end that all assets are distributed, with an extension up to 9.5 months. The last PBGC filing is due for the plan year in which benefits are distributed, and then the annual funding notices are due until all benefits are distributed. Now I'll turn this over to back to Colleen for the details of the steps in the termination.
Okay, thanks, Blaine. As topics go, listing out the steps in the plan termination process is about as dry and dull as it gets. But I'll try to go through it quickly, just because you need to be aware of how some of the timing is interdependent and needs to be coordinated. And because of that, we recommend laying out an intended timeline at the outset of the termination project. So when you've chosen an official proposed plan termination date, you need to adopt a board resolution to terminate. You need to amend your plan to terminate and define the process. As Blaine mentioned, you may need to add a lump sum option if necessary. There is then a notice of intent to terminate that's provided to all participants at least 60 days, but not more than 90 days prior to the proposed termination date. There is another notice that sometimes is sent at the same time as the notice of intent to terminate, and that's the Notice of State Guarantee Association's coverage for annuities, which needs to be distributed at least 45 days prior to purchasing annuities. So that's actually a long ways out at this point, but it can be provided basically at any point in the process. So many times it's sent at the same time as the Notice of Intent to Terminate. The purpose of the Notice of State Guarantee is to basically list the annuity providers that you'll be considering for providing the annuities. As Blaine mentioned, you don't need to file with the IRS for a determination letter, but it is recommended. There's no specific due date, but you should file before the filings are made with the PBGC, which is the Pension Benefit Guarantee Corporation. Make sure you leave time for sending notice to interested parties that needs to be sent 1 to 3 weeks prior to filing with the IRS. There's also a notice of plan benefits that needs to be distributed to all participants within 180 days of the proposed termination date and before the Form 500, which is the next bullet. Now, this notice includes all the details about the plan's provisions, as well as details on each individual's benefits and the data used to calculate them. So this, goes to Blaine's point about making sure you have all the data available for your benefits, because this is what you're providing to your participants. Now, that notice of state guarantee association coverage of annuities is sometimes sent with this notice of plan benefits also. Then you need to file the PBGC Form 500 also within 180 days of the proposed termination date. The purpose of this is to provide the PBGC with certain information on the plan, the estimated liability, and certify that the plan is going to be sufficiently funded to provide all the benefits. Now, you can kind of tell that the timing of these three is very related. So many times, all of these three filings and notices they're many times sent within days of each other. So there's some coordination. There's significant work to put these together, and there's coordination on getting them all out very close to each other. Then the PBGC review period runs from when you file the Form 500 filing to 60 days later. That is subject to extension. After the review period ends, the plan termination is deemed approved unless a notice of noncompliance is issued. So it's basically a no news is good news situation there. The IRS review period for the determination letter has no set timing, but it's typically 9 to 12 months, and if all is in order, you'll receive an IRS determination letter. So that's the point where you're ready to go. You distribute your election forms to your participants at least 30 days prior to the distribution date, and then make sure that you're purchasing your annuities and paying your lump sums within 120 days of getting that IRS determination letter. Now, if you decided not to do the IRS determination letter, you need to purchase the annuities and pay lump sums within 180 days of the PBGC's review period when it expires. And watch the timing here, because if you're near the end of a plan year and there's a change of lump sum assumptions coming, you want to be mindful of that. Once all the distributions are made, you're going to file the PBGC Form 501, which is a post-distribution certification. It's due within 30 days following distributing all benefits. And now keep in mind that this process could be 12 to 18 months, since you began this. So this goes back to Blaine mentioning maintaining good records, because when you file the Form 500, you're telling the PBGC the benefits that are due to the participants. And when you file the Form 501, you're telling the PBGC the benefits that you paid out. And so you're going to need to be able to reconcile from one filing to the other and know what happened to the participants in between. This is also where you would turn over to the PBGC any benefits that are due to missing participants. And don't forget, you need to file your final Form 5500 within 7 months of all trust assets being distributed. And that there is an extension on that, like usual. But note the change in timing. It's not based on the plan year anymore. It's based on the date assets have all been distributed. And there's also a final PBGC premium filing. And then I didn't mention it here, but 1099-Rs are sent to participants, but that's usually handled by the plan's trustee, but just be mindful of that as well. So we're running short on our time here. I just want to mention the key takeaways regarding this process is that plan termination doesn't happen within weeks or even a couple months of the decision to terminate. It's typically a 12 to 18-month process. There's a lot of financial, data, communications, and business objectives coupled with market conditions that impact your decision. The devil's in the details, and be prepared for obstacles along the way. Planning ahead is key to managing this process as efficiently as possible. Thank you very much for your attention. If you have any questions, we do have a minute or two left here, and we'll stay on the line to answer any additional questions that come in. I wanted to mention, while we wait to see if there's any questions that come in, that we're planning to organize some face-to-face workshops in some of our markets. And for those that want to dive a little deeper into these topics, you can see the topics listed here for these workshops. We can customize the discussions for specific issues of small groups as well. And if you'd like to receive an invitation, please email Alyssa Morosco at the email address listed here on this slide. All right, we've come up on our time here, and with no questions. We've covered quite a bit in a short amount of time. Feel free to call or email either of us about your specific questions. The audio recording of this meeting will be posted on our website in the next 2 days. Look for an email with a link to the recording. Thank you again for joining us, and this concludes the Finley Davies webinar.